quarter has been its worst since 2009. The company has failed to get off to a good start in 2016, and Menaka and Kritika Saxena find out what TCS intends to do.
Q3 traditionally is a weak quarter,
I know.
but this time is worse than ever before.
This is true especially in terms of dollar revenues, which have come in at their lowest since FY 2009. No surprise then that October-December 2015 has left India's largest IT company, which holds a record for beating analyst estimates for 10 consecutive quarters, is not feeling very comfortable. Delays in project execution and decision-making in India have hurt TCS's growth by 50 basis points on a constant currency basis. Arguments that North America and Europe have done well provide no relief. So, despite this sluggish India business being termed a one-off occurrence, TCS will continue to reduce its exposure to India.
I wouldn't say India is a headwind or anything. India has been volatile and we've been trying to fix that. Our India business has also come down from 13% of the revenues to 6%. This quarter, the extent of drop is more than we anticipated because it's not a single client.
Adding to the pain is the fact that integration of its subsidiary CMC has begun to hit revenues from India. This quarter alone, that damage stands at 100 crore rupees.
As we have integrated CMC, some of those renewals we have not necessarily, as we are realigning that portfolio closer to the TCS business mix. So some amount of drag is coming from that also. So it's nothing about going wrong, but overall, unless the investment, actual money on the ground investment cycle picks up, this market is going to remain in this mode.
Its business in Japan and volatility from its UK subsidiary Diligenta are also sore points. But in both these areas, TCS expects some relief over the next quarter. But what has rubbed salt in TCS's wound is the US government's decision to increase the H-1B and L-1 visa fee, which will add to employee costs.
It will be upwards of 25 million for us. Whether
Upwards
it's
of 25
million, it could be 30, 40 million or so. Depends on.
But south of 50 million?
South of 50 million, yeah.
South of 50 million.
South of 50 million.
The one pleasant surprise in the third quarter has been TCS managing to maintain margins at 26.5% and sticking to the projected margin band of 26 to 28%. But adhering to this target band means less business flexibility.
The 26 per se is a strategic peg, and that strategic peg gives us a lot of headroom, right, to do what we believe is right. So if we were to change our business mix in a manner where that is changed, we will call it out. But we are not wedded to that. The 26 to 28 has to be seen very tactically.
So far, TCS has managed to maintain its lead over its peers in terms of business execution, the growth of its digital business and margin expansion. But it has still turned in a disappointing performance for the sixth quarter in a row, and that has analysts worrying over whether the entire industry is in for a tough 2016. In Mumbai with Menaka, Doshi, Kritika Saxena.
So a disappointing, muted quarter from TCS. Infosys is